India's top IT services companies are showing incremental improvement, but the recovery remains fragile. First half revenues growth for the top 9 players is still stuck in low single digits year on year. While second quarter improved sequentially over the first quarter, the real test now is the durability and pace of that recovery into the second half. Margins offer limited support. EBIT margins in first half were broadly flat year on year, despite meaningful rupee depreciation and deferred wage hikes. High utilization has supported profitability so far, but that cushion could narrow as wage hike resumes and localization costs rise. AI remains central to company narratives, spanning productivity tools, client use cases, and internal efficiency. But meaningful differentiation is only beginning to emerge. Some companies are investing directly in AI data centers, while others are leveraging AI, cloud, and analytics to move the conversation from promise to execution and measurable impact on growth. So what should investors track next? Clear signs of growth acceleration in second half, sharper visibility of AI's net impact on revenues and margins, and sustained gains in employee productivity. Despite a 21% underperformance of the IT index versus the benchmark, valuation remains elevated, making growth recovery, not cost support, the key trigger for a sustained re-rating. This is Deep Dive, and this time, let's kick off the show with Ichika's roundup of the sector and key commentary by players on AI investments.
Yes, that's right. Now, Nifty IT has had a good, resilient year in 2025. Let's talk about some of the highlights here. Now, Nifty has had a good rally. IT companies, especially this year, quite resilient, especially since October 1st to date. Now, one of the best performing stocks since October 1st has been Persistent Systems. It's up 27%, followed by Coforge and HCL Tech delivering good. And talking about the key sector trends in 2025, we have digital transformation spending, cloud adoption, and a gradual shift towards AI-focused companies abroad, amongst other key trends such as cybersecurity demand, outsourcing, AI integration, and machine learning, right? Now, talking about valuations, the mid-cap IT companies have been more expensively priced, whereas large caps such as TCS, Infosys, HCL Tech, they're more reasonable, right? And talking about the Q2 earnings roundup, we have TCS. You can see it is up Q on Q, but its PAT has missed by 5.4%. Now, Infosys has beat both revenue and PAT EBIT numbers as well as PAT quarter on quarter. You can also see HCL Tech here beat both revenue, EBIT margins as well as PAT. Now, moving on about expectations. Now, most IT companies have beat the street expectations. You can see here on the screen. Now, TCS has beat revenue expectations but missed PAT by a little. We also have Infosys who has beat both revenue and PAT, right? Moving on to 2026, we can expect a stable recovery across companies in the sector and hopefully an even more resilient year. Back to you.
My guest today is Sudhir Singh, who is the MD and CEO of Coforge. As you look at the entire IT space in 2025 and going into 2026, there's the biggest challenge which the IT sector is facing is with respect to how it's going to play out the AI cycle. 2025 has been a little, underwhelming for many of the IT companies, with the index underperforming the benchmark, but IT companies have rebounded in Q2. The numbers have been better than Q1. And going into the next financial year with US interest rate cut, the discretionary spend is expected to be better. But the conversation still moves around AI. Sudhir, thank you very much for joining us today on Deep Dive. To begin with, you're one of the companies which have outperformed many of the big players in the last few quarters. How are you playing the entire AI move, and how is Coforge managing the entire expectation?
Sajid, it's really good to be here, and thank you for making time for Coforge, for the Coforge story. From our vantage, and we called this out 3 years back, when there was a lot of ambient noise around, is AI going to be deflationary versus being a tailwind? We've always maintained, and more than maintained, we've always delivered upon the premise that we publicly stated, that AI is a significant a very significant tailwind for the industry on an ongoing basis. So the way we've played it over the last 3 years now has been to focus on what we internally call creating AI fluency. Creating AI fluency across our customer base and also creating AI fluency internally. From our vantage point, we've always said that AI cannot be a technology imperative alone because it's in client organizations, it's in service organizations where AI is a tech imperative alone where conversations start teetering, tottering, heading towards what is euphemistically called the pilot purgatories. If AI is a business imperative, and it has to be a business imperative, if the solutions are business issue-led, then AI, given the power of the technology, given the ability to structure newer solutions that we couldn't in the past, becomes a massive tailwind. The other piece that we found very interesting outside our own belief around AI fluency being integral, being essential for driving growth, is the fact that with AI having come in and the entire world, boards across enterprise organizations, being absolutely aware of the criticality of this technology to drive innovation, to drive transformation, to drive change at scale, is the fact that we find increasingly that technology budgets have become elastic. They are no longer inelastic. If a service provider can lead in and generate that fluency through a business solution, walk in and say, hey, listen, we understand Mr. X, Mr. Y, Mr. Z. As the CEO of the organization, your firm faces the following issues, and this is an end-to-end solution. No organization, and I say this with absolute conviction, having worked with most of these organizations on a daily basis for the last many years, is ever going to turn you around saying, our budgets are fixed, our budgets are constrained, and we can't spend them.
Interesting, Sudhir. One of the biggest challenge which the IT sector is facing is with respect to the discussion and execution of AI. One of the big things which investors are looking at is that how Gen AI is going to have an impact both on productivity of existing order books and also how it's going to bring in better opportunities. How, as at Coforge, and how, because you have a good view, how are you looking at this entire argument of productivity versus opportunities?
Well, Sajid, great question. And as you can imagine, it's a question that's asked often. I think the proof lies in the numbers. There's no point talking in the realm of the future or talking in the realm of what is likely to happen. If you look at us over the last 3 years, after the MLOps-led transformation that was playing out with Gen AI having become the talk of the town almost 3 years back, and with conversations now increasingly heading towards agentic AI-based autonomous operations, our track record around signing large deals, both the velocity of the large deals and the median size of the large deals, attests to the fact that AI, as we see it, has been a clear creator of a longer growth runway for us. So that's how we've seen things play out. Last year, we signed 14 large deals. This fiscal year, heading into the year, right at the outset, given the extreme confidence that we had in our ability to create AI fluency and to win off the back of the AI fluency that we create, both externally and internally, we had started the year by saying that we will, with the advent of AI, with our ability to merge emerging technologies to create business solutions, we will at a minimum sign 20 large deals. And I think, again, as I said at the start of this question, the proof lies in the performance itself. At the end of the first half, we've signed 10 large deals, almost all of them proactive, every one of them AI infused, and we are well on way to hitting, if not exceeding, the 20 mark that we set for ourselves, Sajid, at the beginning of this year.
Interesting. If you can also give us a sense of the sectors or segments or verticals, which many companies call, whether it's BFSI, manufacturing, retail, healthcare. which are the sectors where you see the maximum application of AI? So clients are asking you as a service provider to provide AI-led platforms, or or could be productivity gains coming in.
Sure. So from our vantage, when we look at industries, we are culturally wired to go more into the subsegments than into broad swath industries. Where we see significant disruption coming in the travel space is around the entire airline industry and the airport subsegment. Airlines are on the next 10 to 15-year growth journey where one order, one offer is going to be central to driving growth. And the promise of one order, one offer is going to be unfulfilled if AI-led solutions are not central to it. Similarly, airports over the next decade, possibly the next 2 decades, are going to have to recreate themselves both digitally and physically as retail malls. Again, the AI-led emerging technologies, a composite of those technologies creating business solutions, is going to be integral there. So on the travel side, we see airlines, airports, both of them likely to see AI as being central to the entire transformation that's going to be in play over the next 10, 15, maybe 20 odd years. On the banking side, we've always regarded ourselves as capital markets buy-side specialists. Capital markets buy-side, the entire space, starting from regulatory compliance all the way to customer acquisition or institutional customer acquisition retention, is going to be an AI-led play. And finally, insurance, again, has been a sweet spot for us. Insurance has been a laggard when it comes to technology adoption. If you look at insurance, cloud adoption, they were possibly the laggards. This time, there's a very strong bias to make sure that with AI, that trend is not repeated. Within insurance, particularly specialty insurance, we see with the advent of geopolitical uncertainty, with the advent of newer complexity and newer products out there, with the requirement to have these hit the market with shorter cycles, analytics, creation of these products, and the platforms that support them, again, are going to be AI-led.
Interesting, Sudhir. How will this impact your revenues or revenues for the industry? Because there's already a chatter about revenue deflation that may come in because of AI coming into play. How will companies like you manage that kind of revenue deflation, even though it brings in more opportunities and more productivity for the clients?
So let me just start with numbers, and then I'll come to the revenue deflation question. Sajid, last year, Coforge grew 31% plus, and last year was a tough year for the industry. This year, at the end of the first half, we are growing almost 38% over the first half last year. So the Coforge story has been atypical, and our conviction that growth is likely to be robust or very robust in the future is unimpaired. We continue to see significant growth coming in. As far as the deflationary aspects are concerned, see, our worldview has always been, and more than a worldview, it's a reality. AI has a play when it comes to efficiency improvements. It's a new technology. It's a powerful set of technologies, and therefore, for existing book of business, AI is likely to have a deflationary impact. However, and I think this however is critically important, there is a larger pool of business, which is the whole innovation, the whole transformation bucket. That's a bucket that is not used to having RFPs getting floated out, because these are still early days, early years of AI as a technology getting understood, and organizations becoming, and I've used this term many times consciously, becoming fluent in them. Therefore, this new market that we are operating in, not the one that's coming, the one that we're already operating in, we believe as an organization is going to be a fantastic market for tech services firms that can lead with solutions, business problem solutions. And it's going to be a pretty tough market for tech services firms that still want to operate with a mindset that is more centered around order fulfillment or order taking. So it's going to be increasingly, I suspect, a market where you will continue to have firms that are outliers when it comes to growth, led through business impact, and then firms that continue to stay with a somewhat more legacy mindset, and therefore their results, their growth is likely to represent the headwinds that an efficiency-only play will impose on them.
I agree with you. The market also rewards outperformance like your company there. Give me a sense of how, what kind of change in metrics will be there with respect to AI? When I say that, I want to ask you whether the traditional way of measuring company performance, does it change? What should the street be looking at to measure whether a company is now AI ready and AI delivering or executing orders on that parameters? Because the traditional way of looking was to how many headcount in addition happened for an IT company, but that's not valid any longer. So there are new metrics or new parameters which are coming into play. So as a company which is agile and taking up new projects with AI-led execution, how do you what kind of metrics are you looking at, and what should the street be looking at?
I think it's a great question, Sajid. I can tell you the metrics that we are looking at internally, and you're absolutely right. The metrics have moved away from just assessing business teams, business leaders, sales leaders on just revenue, EBITDA, which were the metrics earlier. Instead of revenue alone, we increasingly look at the velocity and the median size of large deals that are being signed. Our belief is large deals, order book, are not a lagging metric like revenue is, but they're a predictor of what the future on the growth front is going to be. So increasingly on the revenue side, you might find that analysts, that firms internally like us, are looking not just at revenue, which is a lagging metric, but also looking at the velocity of large deals getting signed, the median size of the large deals getting signed. The second thing that I suspect, which will slowly start inching in, is we've all within this industry largely looked at EBITDA as the principal margin metric. You might find with acquisitions, with mergers becoming more common, EBIT is a metric that does factor in amortization, depreciation that comes as a consequence of those M&As becoming more important. So that's going to be the second metric that we see. The third metric, and again we're looking at it internally, is revenue per employee. If the pyramid does become a diamond, and we believe it will, we are already operating as a diamond-shaped delivery organization. If services are not truly being driven by those deflationary wins, but are business value-led, revenue per employee, given the value creation that is implicit in some of these solutions and proposals, is likely to increase. So just summing up, revenue is, I suspect, going to be important, but leading metrics like large deals, what is the speed at which they're being signed, what is the median size of those large deals, is it going up or not, is going to be the first piece. The second is, I guess, EBIT will become as important as EBITDA, even internally for firms like us. And third, of course, revenue per employee will continue to be a big metric to figure out what is the true value addition being offered by teams, and to what extent is it being recognized and paid for by the end recipient, which is clients.
Are management like yours okay with revenue deflation as long as the orders are, tech led and tech in AI heavy? Because I hear that when marketing teams or the business development teams go out, their performance is measured based on the kind of orders they bring in. With revenue deflation coming in, are managements okay with that kind of philosophy?
No, absolutely not. I don't believe there is revenue deflation coming in. I think there's revenue acceleration that is on the anvil. As I said at the outset, this is a fantastic market for solution creators. It's a very tough market for order takers. If we are going to be a solution creation organization, if we are going to be a hyper-specialized organization in specialty insurance, in airlines, in airports, in capital markets buy side, And if we are leading with solutions, I would never expect my sales team, I would never expect my business leaders to come back to me and say, hey, listen, this is a deflationary environment. Growth is going to be negative or going to be slowing down. We think it's a fantastic environment for teams that as a composite across the architects, across the program managers, across the engineers are walking out there with solutions that are proactive. So I would continue to measure my team in terms of revenue growth. I would continue to monitor the velocity of large deals and the median size of large deals. We will continue to look both at EBITDA and the EBIT inching up. And of course, we will hopefully take a lot of pride in seeing revenue per employee going up.
And if that is the case, is it fair to assume that the EBIT margins which we look at are likely to go up because your revenue per employee is also going up in that sense?
That's right, Sajid. I mean, this year, if you look at our numbers, almost over the last 12 months, our revenue per employee on the tech services side has gone up almost 17%. We started off the year and we were a bit of an outlier again, not just in terms of revenue outlook, but margin outlook, where we said that our EBIT was going to expand by more than 100 bips. And so far, we seem to be on course towards hitting that number.
And does the size also help you in being agile while delivering or executing these orders? Because bigger organizations take time to turn around and deliver or execute orders at a shorter period of time. But organizations like yours, which are compact and other and smaller than the top 2 to 3 organizations, you have more agility in respect to execution of orders and ensuring that you are able to book the revenues much faster than others.
I think it's less to do with size because 8 years back we were the 18th largest Indian IT services firm. Today, as you and I speak, Sajid, we are the 7th largest. We are within kissing distance of hitting a $2 billion revenue run rate, and we hope to get there as soon as we can get it. I think it's less to do with size. It's more to do with the orientation. AI fluency, the disruption being driven by AI, is going to get addressed only by tech service providers that are as fluent on the tech side as they are in terms of being hyper-specialized around select industry subsegments. That's easier said than done. It's a change that takes years. It's a change that warrants immense, not just investments, focus, and it's a very, very, very difficult change management exercise. But once undertaken, and if undertaken successfully, it becomes a massive moat. We like to think, and more than like to think, I think our results show this, that the investments that we made over the last 8 years, which are both around tech and domain, given the advent of AI now positions us in a very unique space. We're not just talking engineering, data, and cloud. All three are important. But we're talking engineering, data, and cloud fused with hyper-specialized industry experience, which to our mind is what AI fluency is all about.
How do you look at the global business environment? Because 2025 has been a disruptive one for many. As you look into 2026, and you've been talking to all your clients with respect to the kind of IT spending expected for next year as well, how do you see this environment? Do you see improvement coming into IT spends going into 2026?
Sujit, if one looks at enterprise budgets, I suspect enterprise budgets in calendar year 26 will be broadly in line with the enterprise budgets in calendar year 25. And there might be improvement on the margins, but only on the margins. However, let me qualify that by saying even calendar year 25 was a great year, given the fact that tech spend with the advent of AI is now regarded as being elastic for solution creators. So when we look at the world, we believe that hard-coded enterprise budgets are not going to see a very material change, upside or downside compared to 25. But the environment will continue to be extremely conducive for solution creators, teams walking in with a solution for a client that is grounded in the context of their business, their process, their functions.
Sudhir, if you can also give me a sense of how GCC has been able to have an influence on the Indian IT system. there were arguments that IT companies can use that as an opportunity because they can service the GCCs as well. From your vantage point, how GCC has been able to disrupt, or is it an opportunity for you as well?
So let me start with the latter part of the question, Sajid. For us, only 1.5% of our revenue comes from GCCs. There's another 8.5% that comes from working with GCCs, but as part of broader global MSAs. So exposure to greenfield GCCs is only 1.5%. However, we recognize that it is an opportunity, right? GCCs, a lot of GCCs are increasingly being scaled up across India as innovation centers. We see those as partnership opportunities. That 1.5% of our revenue, please recognize, is for a firm that has almost doubled its revenues over the last 3 years. So it's a fast-growing component, but not the only component of our growth journey. We have multiple growth axes. GCC we see as one of them. We have set up an exclusive specialized GCC sales team. We've set up and released our own framework around GCC. At this point in time, we see that as a net positive. We're really not seeing that as looking at our client sets as an area that is going to have any kind of a negative deflationary impact on our growth numbers.
I know it was a pleasure talking to you, Sudhir. That was Sudhir Singh, MD and CEO of Coforge, talking to us on the way forward in 2026 and how Coforge is managing and how the how he sees the IT sector managing the entire transition to become an AI-centric IT services industry. Thank you very much for joining us today and joining us on Deep Dive today, Sudhir.